The White House called it a strong economy. On the morning of March 6, 2026, Kevin Hassett, director of the National Economic Council, walked onto the set of CNBC and told viewers that the numbers were consistent with what the administration expected. He said the labor market was exactly where they anticipated it would be. He said the economy was strong. Meanwhile, 92,000 Americans lost their jobs in February. Not might have, did. The economy did not add jobs. It did not flatten. It contracted for the third time in 5 months. And the markets, the bond traders, the Fed officials, and frankly anyone who read the full Bureau of Labor Statistics report understood immediately that this was not one bad headline. This was the surface crack of 3 structural breakdowns arriving at the same moment. That is what this video is about, not the number, the 3 layers underneath it. Every number in this video comes from institutional sources, the Bureau of Labor Statistics, Challenger, Gray, and Christmas, and the Federal Reserve's own market instruments, cross-referenced against 3 independent data sets, all telling the same story. By the end of this video, you will understand why the February jobs report is actually 3 separate reports collapsed into one. You will understand why the Federal Reserve is now trapped in a position that has only one historical precedent, and what that precedent ended up costing the people who lived through it. And you will understand why the official narrative calling this a strong economy is not just wrong. It is a specific kind of wrong that tends to get more expensive the longer it is maintained. Before we go any deeper, hit that subscribe button and drop a comment telling me, do you think the Federal Reserve will cut rates in 2026 at all, given everything that is happening with oil? I read every single comment. Let us get into this. So let us start with what the headline number actually hides. 92,000 jobs lost. The consensus estimate from economists surveyed by Dow Jones was a gain of 50,000. The estimate from LSEG was a gain of 59,000. The actual result was negative 92,000. That is not a miss. That is a reversal of nearly 150,000 jobs from what the professional forecast community expected. But here's the thing. The headline is almost the least interesting part. In December of 2025, the Bureau of Labor Statistics initially reported that the economy added 48,000 jobs. When they revised that number in last Friday's release, it became a loss of 17,000. In January, the reported figure was a gain of 130,000, which itself looked like a recovery signal. That was revised down to 126,000. Combined, the revision stripped 69,000 jobs from the record, which means the actual 2-month average for December and January together was considerably weaker than anyone was told in real time. Here is what that means at the macro level. 2025 is now the first year since 2010. The year the economy was still recovering from the global financial crisis, with 5 months of payroll contractions. Since April of 2025, the economy has lost jobs on net. The total payroll change from last May through last February stands at negative 19,000. The United States labor market has, in aggregate, gone backward for 10 months. Per the Bureau of Labor Statistics monthly establishment survey, the sectoral breakdown tells an equally uncomfortable story. Healthcare, which had been the single engine holding the entire labor market together for the better part of 2 years, shed 28,000 jobs in February. Driven largely by a strike at Kaiser Permanente that affected more than 31,000 workers during the survey week. Healthcare had averaged a gain of 36,000 jobs per month over the prior year. In 1 month, that entire engine reversed. The information sector, which includes technology and media, lost 11,000 jobs, extending a downward trend that has now averaged 5,000 losses per month for a full year. Manufacturing lost 12,000 against analyst expectations of a 3,000 gain. Federal government employment fell by 10,000. That last number needs its own paragraph. Think of it like a building where the load-bearing walls were already showing stress. February did not add new weight. It made the cracks visible simultaneously. Since October of 2024, federal government employment has declined by 330,000 workers. That is 11% of the entire federal workforce, gone in roughly 16 months. No administration in modern history has contracted the federal payroll at this pace outside of wartime demobilization. These are not temporary furloughs. These are structural eliminations of positions that, in most cases, will not return. The long-term unemployment picture is the detail that rarely makes it into the headline, but it is the one that tells you the most about the direction of travel. The number of Americans who have been unemployed for 27 weeks or more, the standard definition of long-term unemployed, currently stands at 1.9 million. A year ago, it was 1.5 million. The average duration of unemployment is now 25.7 weeks. That is the longest average duration since December of 2021. People are not just losing jobs, they are losing them and struggling to find new ones. A number like 1.9 million long-term unemployed sounds abstract. It is roughly the entire working population of a mid-sized American city people who are looking every week and not finding. So here is where we stand on the surface. The economy lost nearly 100,000 jobs last month. It has now lost jobs on net across 10 months. The sectoral engine that held everything together just stalled. And the underlying trend, when you strip out the revisions, is considerably weaker than the official monthly numbers were suggesting throughout 2025. That alone is a serious story. But it is not the whole story. And here's why. To understand what is really happening, you have to go back 53 years. October of 1973. The United States is in the fourth year of the Nixon administration. The economy is not in obvious distress. Unemployment is around 4.5%. Inflation is elevated, but not catastrophic. The American consumer is spending. The suburbs are expanding. The stock market is near a peak. Then on October 17th, the Organization of Petroleum Exporting Countries meets in Kuwait City and announces an oil embargo against the United States and several Western allies in retaliation for American support of Israel in the Yom Kippur War. The posted price of Saudi crude oil at the time is around $3 per barrel. Within 5 months, it reaches $11.65. Not double, not triple, nearly 4 times the price in a matter of weeks. Every industrial process that requires energy manufacturing, transportation, agriculture, heating suddenly costs dramatically more to power. Gas station lines stretch for blocks in American cities. Some stations simply run dry and close. The Federal Reserve chairman at the time was Arthur Burns. Burns faced a decision that has no clean answer. The oil shock was pushing prices up, classic inflation signal. But the oil shock was also destroying consumer purchasing power and slowing economic output, classic recession signal. Inflation going up, employment going down, simultaneously. Burns chose the soft path. He prioritized employment. He kept monetary policy accommodative. He told Congress that the rules of economics were not working quite the way they used to. What he actually created was the framework for a decade of embedded inflation psychology. Every time the economy showed signs of slowing, the Fed responded by easing. Every time inflation surged, the Fed tightened slightly, then reversed as soon as unemployment ticked up. It became known as stop-go monetary policy, and it did not work. By 1979, U.S. consumer price inflation had reached 9% annually. A second oil shock arrived that year, when the Iranian Revolution collapsed the Shah's government and Iranian oil production fell sharply. Prices doubled again. The same pattern, the same structure. Oil shock, labor market weakness, a central bank trapped between two fires. What it took to break the cycle was Paul Volcker, appointed Fed chair in August of 1979. Volcker was not universally admired when he made his move. He was called reckless. Farmers drove their tractors to Washington to protest in front of the Federal Reserve Building. The National Association of Home Builders mailed him 2x4s with notes about the construction jobs he was destroying. Volcker raised the federal funds rate to 20% anyway, not by accident, deliberately. Unemployment hit 10.8% in November of 1982, the highest since the Great Depression. 2 years of administered pain to destroy the inflation psychology that Burns had allowed to entrench over 6 years. And it worked. By 1983, inflation was back below 3%. The cycle was broken. But the cost of breaking it was measured in foreclosed homes, shuttered factories, and families that never fully recovered their financial footing. Check. Verified. Undeniable. The pattern of an oil shock striking an already weakened labor market is not a theoretical scenario. It is the defining economic episode of the second half of the 20th century, and it came with a very specific cost structure. The longer you wait to act, the worse the cure has to be. If this analysis is useful to you, share it with someone who is trying to make sense of the current economic picture. Like the video so more people find it, and let us keep going, because we are only halfway through the 3 layers. Before moving forward, let me crystallize the lesson from the 1970s in one sentence. When inflation is rising and employment is falling at the same time, the central bank has 1 fire extinguisher and 2 fires. The choice of which fire to fight first determines how badly the other one burns. That brings us to the second and third layers underneath the February jobs report. We are not in 1973. This is not a simple oil embargo from a cartel. What is happening in 2026 is a convergence of 3 forces arriving simultaneously. and the February jobs report is the first instrument where all three registered at once. Here's what nobody is connecting in the February jobs data. It is not one story, it is three. The first force is artificial intelligence displacement. According to Challenger, Gray, and Christmas, the outplacement firm whose monthly tracking is the industry standard for layoff announcements, artificial intelligence was cited as the direct cause of 4,680 job cuts in February alone. That represents approximately 10% of the 48,000 total layoff announcements tracked that month. In the first 2 months of 2026 combined, AI has been cited in 12,300 layoff announcements, 8% of all planned cuts so far this year. To put those numbers in context, in all of 2025, U.S. employers directly attributed 55,000 job cuts to artificial intelligence. That was 12 times the number attributed to AI just 2 years earlier. The acceleration is not a straight line. It is a curve that is bending sharply upward. The cases are real and they are not small. Block, the financial technology company founded by Jack Dorsey, announced in February that it was cutting its workforce nearly in half, from 10,000 employees to fewer than 6,000. Dorsey stated explicitly in a shareholder letter that intelligence tools had changed what it means to build and run a company. Salesforce eliminated 4,000 customer support roles after deploying AI systems that now handle approximately 50% of customer interactions, per their CEO's own public statement. The Mercer Global Talent Trends Survey puts a number on the psychology underneath these announcements. Employee fear of losing a job to artificial intelligence jumped from 28% in 2024 to 40% in 2026. 4 in 10 workers now believe they are vulnerable to displacement by a technology that most of them cannot fully evaluate or predict. Major bank analysts wrote in January that this anxiety would go, in their words, from a low hum to a loud roar in 2026. But here's the thing about the AI displacement story. The nuance cuts in an unexpected direction. Researchers at major institutions have documented what they now call AI washing companies, using artificial intelligence as a cover story for financially motivated job cuts. Forrester Research puts the figure at roughly half. That proportion of AI-attributed layoffs will be quietly reversed by the end of 2026, with workers replaced by offshore contractors at lower salaries rather than actual AI systems. Klarna is the canonical example, cut 40% of its workforce citing AI productivity gains, then found quality declining as customers pushed back and began quietly rebuilding headcount. But, and this is the critical distinction, even the AI washing dynamic is a signal. When companies feel comfortable attributing cost reductions to technology rather than performance, it tells you something about where the institutional psychology is pointing. Entry-level positions are disappearing across white-collar sectors. Workforce researchers have documented a significant contraction in entry points into the workforce for new graduates. This is not the robots taking all the jobs story. It is something subtler and in some ways more disruptive, the closing of the on-ramp. The second force is the federal contraction we already discussed. 330,000 jobs gone from the federal payroll in 16 months. Those are not warehouse workers or factory floor positions. They are the analytical, administrative, and technical positions that formed the employment base for a specific economic class, the credentialed, educated, middle to upper middle income worker who historically has been the most stable spending segment of the consumer economy. When that segment faces sustained employment uncertainty, the downstream demand effects reach hospitality, retail, and services within 6 to 9 months. The third force arrived on February 28th. That is when the United States and Israel launched coordinated military strikes against Iran. The operation was not a warning shot. It was a sustained campaign that, within 72 hours, had eliminated the supreme leader and triggered a full retaliatory response from Tehran. The Strait of Hormuz, a narrow waterway between Iran and Oman, through which approximately 20% of the world's oil and liquefied natural gas supply transits every day, was effectively closed by Iran's retaliatory response. West Texas Intermediate crude oil closed at $90.90 on Friday, March 6th. The biggest weekly gain in WTI futures trading history, going back to 1983, 35.6% in 5 trading days. The national average for retail gasoline jumped 27 cents in a single week to $3.25 per gallon. Qatar's energy minister told the Financial Times that if the strait remains closed, oil could reach $150 per barrel. To put that in perspective, $150 oil would represent more than double the pre-strike price. It would push U.S. gasoline above $5 per gallon. That is not just an energy price. That is a pressure system moving into everything that depends on fuel to move, generate, or process. It would add roughly 0.8% to global inflation, according to analyst projections. And it would arrive on top of an inflation rate running at 2.4% annually as of January, still above the Federal Reserve's 2% target. This is where the 1973 parallel stops being a historical metaphor and becomes an operational reality. If you are finding this useful, drop a comment and tell me where you think oil goes from here. Your perspective matters. Now let us talk about what all of this means for the Federal Reserve and for you specifically. According to the CME FedWatch tool, which aggregates real-time futures market expectations for Federal Reserve policy decisions, the probability of any rate cut at the March meeting is near zero. After Friday's jobs report, traders moved the first cut expectation all the way to July, where the probability currently stands at 43.4%. Put differently, the market is saying there is a better than even chance the Federal Reserve does not cut rates at all through at least the middle of the year, despite losing nearly 100,000 jobs in February. The real reason the Fed cannot simply choose the employment side of its mandate is oil. If the Fed cuts rates in response to the weak labor market, it risks adding monetary fuel to an oil-driven inflation surge. Gasoline prices would climb further. Consumer purchasing power would erode further. As one of Wall Street's chief economic strategists put it this week, the situation has the Fed caught precisely. Significant weakening in the labor market would normally support a rate cut. But the risk that higher for longer oil prices could trigger another inflation surge means the Fed may feel compelled to remain on the sidelines. That is the Burns dilemma, restated for 2026. And into this moment walks a new Federal Reserve chairman. Kevin Warsh, nominated by President Trump on January 30th, will assume the chairmanship in May when Jerome Powell's term expires. Warsh will inherit this position: oil above $90, jobs declining, inflation above target, rate cuts priced in by Wall Street, but structurally complicated by the energy shock within months of taking the chair. One more piece of context before we talk about what this means practically. On February 20th, the Supreme Court struck down President Trump's IEEPA-based tariffs in a 6-3 decision. Chief Justice Roberts wrote that IEPA does not authorize the president to impose tariffs. More than $160 billion in tariffs collected since 2025 have been ruled illegally collected, and the case has been remanded to lower courts to determine how refunds would work. The administration responded by signing new tariffs under a different legal authority the same day. But the legal uncertainty around trade policy did not disappear, it shifted. For manufacturing companies trying to decide whether to hire, whether to expand, whether to commit to domestic production, the signal from February 26th through today is the framework for trade policy in this country is still being contested in real time. 12,000 manufacturing jobs lost in February against an expectation of 3,000 new ones. That gap reflects, among other things, the freezing of capital allocation that uncertainty produces. To put the last several minutes in plain terms, three forces arrived simultaneously in February. Artificial intelligence reshaping which jobs exist, a government contraction eliminating a category of stable employment, and an oil shock that removed the Federal Reserve's last easy option. The jobs report is the first place where all three showed up in the same number. Now let us talk about what this means at the level of your actual life. What the mainstream coverage is missing is how directly this connects to your household budget. I am not a financial advisor, but here is what the data suggests. If you are in the information sector, technology, media, digital advertising, the risk you are facing is structural, not cyclical. The information sector has now averaged 5,000 job losses per month for a full year. Cyclical downturns recover when the business cycle turns. Structural shifts require repositioning, not waiting. If you are in the federal workforce or adjacent to it, contractors, vendors, consultants who depend on government spending, the 330,000 job figure is not the ceiling. It is a point on a trajectory. On energy and household costs, a 27 cent per gallon jump in gasoline, sustained for a full year, adds roughly $125 to $150 to the average American household's annual fuel budget. That sounds modest in isolation, but it compounds. Every logistics company, every airline, every distribution network reprices its services upward when oil stays elevated. The delivery surcharge you see on your food order, the handling fee on your online purchase, the increase in the cost of groceries that traveled 500 miles by truck before reaching the shelf. None of those will say oil shock on the label. They will just be higher. The inflationary transmission from energy prices to consumer goods typically runs 3 to 6 months. The full impact of what happened in late February has not yet appeared in your grocery bill or delivery costs. The undeniable historical lesson from the 1970s is this: the people who lost the most were not primarily the unemployed. They were the employed, the people who thought they were fine, whose wages did not keep pace with prices for a decade. Wage growth is currently running at 3.8% annually. Inflation, before the oil shock is fully priced in, was running at 2.4% as of January. That gap is positive. Today, wages are still outpacing prices. The question of whether it stays positive depends on decisions that have not yet been made. Let me be clear about what this is and what it is not. This is not a prediction that stagflation is certain. It is a structural reading of three converging pressures. Whether they combine into a decade-long trap or resolve within months depends entirely on choices ahead by the Fed, by the incoming Fed chair, by the administration, and by energy markets shaped by a war with an uncertain duration. What history tells us, with undeniable consistency, is that the same pattern, oil shock, weakening labor market, central bank caught between inflation and recession, has a narrow window for a clean resolution. Arthur Burns had that window. He chose not to use it. Paul Volcker inherited the consequences. The same window is open now. If this video gave you a clearer picture of what is actually happening in the economy right now, please like it and send it to one person who is watching events and trying to figure out what comes next. Hit the subscribe button. The decisions that get made in the next several months will determine whether this is a rough quarter or a turning point. Either way, understanding the structure is the beginning of navigating it. Arthur Burns thought his situation was manageable in 1973. Inflation was 4% and unemployment was 4.5%, comfortable distances from the worst case. By 1979, both had compounded beyond comfort, not because anyone planned for that outcome, because the same pattern, once set in motion, carries its own momentum. The February 2026 jobs report is not the conclusion of a story. It is the opening paragraph. And right now, the people responsible for writing the next chapter are standing at the same fork in the road that Burns stood at, with the same tool in one hand and two fires burning in opposite directions. The data is on the table. The historical precedent is available. The undeniable question is whether the lesson gets applied or learned again from scratch. Thank you for watching The Global Finance.